Financial models have become the most important decision making tools in finance. FMI is the world's only financial modeling accreditation body. FMI's accreditations empower finance professionals to strengthen and validate their financial modeling skills. Learn more by visiting fminstitute.com today.
Welcome to Compound Insights, a podcast by CFA Society New York. I'm your host, Rob Rowan. Today we're talking about the high yield market, and we're talking about them with Mike Best. Mike is a managing director at Barings. Previously, he was at Bank of America, and he got his bachelor's degree from Vanderbilt. So, welcome to the podcast, Mike.
Thanks for having me on. Appreciate the opportunity.
I'd like to start with your relatively high-level view of the high yield bond market. Could you share your view of, the market from the top right now?
Yeah, absolutely. I think it's an interesting time in high yield bonds right now. I think investors are grappling with maybe some spreads that are on the tighter end of historical basis, but you're presented with yields that are sort of well above average, and prices and effective duration, which are two metrics that investors use a lot, both being sort of below long-term averages. So you're getting discounted prices, a shorter duration market, decent yields. But the give up is obviously spreads are a little bit on the tighter end. I do think this, what we see right now is this creates a sort of an opportunity to buy discounted assets with an attractive sort of pull to par, or even better, a yield to event type of return.
Could you just drill into what types of events you mean when you say yield to event, please?
Yeah, absolutely. I think when we talk about yield to event, there are sort of two types of events that can occur. One are the more difficult to predict events, things like acquisitions, M&A, positive credit catalysts. Certainly, we always want to identify those as best we can. But I think the other one is much more simpler, and that is just maturity refinancing. And if you think about it from a CFO perspective, a CFO of a high yield company, unlike maybe larger investment grade counterparts who believe universally they're always going to have access to capital markets. High yield CFOs, generally speaking, want to avoid current debt maturities at all possible costs. And what that means is that they're usually going to refinance things out 1 to 2 years out in advance of maturity. What that means from a sort of mathematical perspective is that if you look at the high yield bond market right now, when we already talked about that price discount that's apparent in the market, and you start to run yields, you get a yield to worst number, but the yield to worst is actually all the way out to the maturity date.
Right.
Where if you start to look at things 1 year inside of maturity, or even better, that's where you can start to pick up a little bit of additional sort of total return. And there's a little bit of, I think, hidden yield sort of in the market, so to speak. So, yeah.
I'd like to, get to the due diligence issues that are inherent in in the high yield market in a second, particularly for the bond market. But let me go back to something I would be remiss to talk about if we didn't talk about it, because everyone's talking about it, and that's rates. Um, so, what's your view? I'm assuming that you all are not sort of preoccupied with rates in the short run. You're thinking more about what it means for the high yield issuers in the longer run. Could you talk about that a little bit?
Yeah, absolutely. I think in the longer run, certainly, we're very focused on fundamentals. And I think in the longer run, interest rates are going to have some impact on the fundamentals of the various companies that we invest in. I take it a couple of different ways, and I sort of think about it. And there's been obviously, a lot of news, a lot of articles written about it. But keeping things very simple, risk-free rates, generally speaking, over the last decade plus, have been in the 300 to 400 basis point range. We've had long-term treasury rates. Let's say I'm going to ignore the short end of the curve for the second and just say long-term rates have risen by 400 basis points in the last several years. And if everybody immediately had to refinance their maturities, well, then mathematically you kind of double your interest rate. And that obviously is a very simplistic way to look at it. The good thing and the good word about it is that not everyone needs to refinance immediately. Most of our borrowers are savvy borrowers and sort of have a staggered maturity profile. So they have a good runway. They were refinancing 2021, 2022, 2019 at extended maturities and are benefiting from some of those below market rates. But certainly, I think we'd be remiss to sort of ignore it is high yield after all. And there are some credits and some companies that are out there where you are going to start to see some issues on the lower end of the credit rating spectrum, where you will see a rise in defaults. Because capital structures will be more or less unsustainable for some of those borrowers. And certainly, if they have any slip up in financial performance and they've doubled their interest cost, that can obviously lead to some defaults in the market.
Yeah, so one of the things that is, is always an issue when you think about this is that while there might be some companies with a debt structure that gives them some flexibility in the next couple of years, they eventually get to the higher rates, and they can't avoid higher rates because they have to buy stuff from other companies, to put it frankly. And there's often a little bit of interest rate expense in there. Is that the type of risk that you're looking at for those companies that don't have a credit structure that you think is provides that cushion?
Yeah, I think there are some sectors and there are some companies in just sort of big pictures thinking about them where they have very intensive capital needs, may have some sort of transformation that needs to go on where you can talk about it in the legacy media and telecom markets, for example, where you have some companies that need to transition to newer technologies and better technologies, and that costs capital, it costs money. And inflation being what it is means all of those pieces cost them more money. When you couple it with the fact that their interest expense is also going to double, they either need to pull back on one of those two things, spend less capital and potentially be more disrupted, or pay more interest expense. We think those are the spots and those are the things that we're sort of looking at and worried about in terms of new possible points of distress in the coming years. I think obviously for very obvious reasons, 2022 and 2023 have had quite a large washout effect, if you will, for some things that have already been identified and are already more or less trading at recovery rates. So I'm not talking about those things. I'm talking about new potential risks that may take some time to sort of come onto the horizon and become immediately thought about. But I do think longer term, those are the types of things where you're going to see some distress.
Okay. Do those boil into subsectors, or are they individual issuers that you have concerns about, in addition to the one you just mentioned?
Yeah, I think it's mostly subsectors. It's really the easiest way to think about it. I think there are certainly some individual companies that are, I can pick on legacy things like yellow page advertisers and
Right.
some obviously, sort of the modern day buggy whip manufacturers, if you will.
Right.
But but the truth is that most of the issues I think are really going to appear in some of those things where the transition just needs to happen and it's capitally intensive. We don't see that so much. I think the one area that I think was a little bit of focus more immediately was that there are some technology companies that sort of exist out there that borrowed a lot of floating rate debt, and they might have borrowed in the leveraged loan market a little more heavily and then the high yield bond market, and certainly their interest costs have doubled. The good thing for most of those businesses is they're sort of undergoing or past their transition and or are growing. And so if you can grow into your capital structure, growth solves a lot of problems. And so it's more for that sort of legacy lower growth businesses that are subject to disruption. And I sort of pick on some of the legacy media businesses, but those are the ones that and other things of that nature that'll see some trouble.
Yeah, I wonder as a sidebar, if, there are other things that's going to accelerate those trends for some of those legacy businesses, like the explosion in AI. How are you all looking at that?
Yeah, it's I think initially we certainly didn't think it was a high AI was certainly a high yield bond market or high yield loan market sort of concern because most of these companies are more or less in stable legacy industries. But I do think there are some services businesses. We've seen a few of them that have sort of, I think, started to pop up and have some disruption. And I think that's and again it's things like for example software legacy services that might have read documents and provided insights on the documents. Well, if AI can do an effective job on those, then you do question some of the longer term nature of some of those businesses. So we do see a little bit of that. For the bread and butter of the high yield bond market, though, I think many of these companies, telecom, there's lots of good telecom, there's lots of less than good telecom, but some of that is infrastructure that's going to need to exist and probably grow as a result of AI. So there are some crosswinds that sort of exist between some of those sectors.
I wonder as I think about the organizations that need infrastructure investments, one of the ones, or the subsectors, I should say, that need infrastructure investments, one of the things that I think about that a lot of people don't think about is power. Now, a lot of those are public power, so they're a little bit out of the high yield market. But have you all seen any, looked at that sector at all?
We do have a few companies in our sector that do sort of deal with some of those cross currents. We, in fact, have looked at one high yield bond issuer in the last year who was even going into Bitcoin mining potentially as a way of sort of selling its power and thinking about that.
Yeah.
But as you sort of mentioned, mostly that is exists out of our market in the big public and the integrated utilities that are out there. So a little bit less, but even those types of trends can find their way into the high yield bond market sometimes.
Let's shift a little bit because I would like to talk with you a little bit about sort of the market as a whole and some of the nuts and bolts of the financing. There's been a really appreciable reappearance of junior debt. I wonder where you see that trend right now, and what do you think it means for the sector?
Yeah, I think that this is a trickier one to answer because I think obviously certainly one of the signs of frothiness in credit markets historically has always been large increases in junior debt issuance, subordinated debt. It could be subordinated debt of investment grade companies. It could be triple C rated issuance for leverage buyouts. It can be lots of those things. I think that what we're seeing is that there's certainly some disintermediation going on within the high yield bond market, within the private credit market, within the leveraged loan market, where you are starting to see some of those riskier pieces come and take market share from one market or another. The good news is for large public companies and large high yield bond issuers, that's mostly not a major concern until we get to something I'll speak on in a second. But I do think that that's a trend that will probably continue. We know lots of capital has been allocated and expected to be more is probably expected to be allocated to that private credit market that will take some of that share. But what we're seeing in the larger public companies right now is that by and large, junior debt is not necessarily growing at the same clip as some of those other markets. And so the reason why it's not growing is sort of demand and supply. On the demand side, the last 12 months and really the last couple of years have increasingly provided more opportunities to earn yield without stretching on credit risk. And so investors can find lots of attractive yields in the high yield bond market, which is about 55% today, double B rated. Only about 10% of it's triple C rated, and the rest of it sits as single B rated.
Right.
And so investors can buy a lot of those quality type companies and earn good yields and good returns without having so demand is low. On the supply side, which is always important, got to look at the balance, right?
Hmm.
Private equity firms are generally speaking the largest issuers of sort of subordinated, publicly traded high yield bonds. And what we're seeing right now is that, I mean, they use that obviously for a variety of reasons. Returns on equity helps them boost their returns on equity. We're seeing less supply of that for sort of two primary reasons. One is that higher interest rates overall are having an impact on their ability to really load the same quantum of debt onto
Right.
companies that they
Right.
could 5 years ago.
Right.
And so you really can't lever a company up to, you know, four, five, six times the same way that you could before, unless it has, very low capital intensity and some of those things we talked about.
Right.
But they also have alternative options that are to sort of boost their returns. There's preferred equity, there's NAV financing, there's other
Hmm.
things that exist outside of our markets and are more private in nature, but nonetheless, I think help them with that. And then also, we're just not seeing a lot of M&A. I think that is another key theme that we're monitoring, which is you're seeing the absolute levels of M&A are quite low on a historic or certainly in the last 10 or 15-year basis. The reason predominantly being cited to us is that sellers of companies are looking at equity valuations in publicly traded markets, and they're looking at certainly where they think their valuation on their own company is, and they're having a large disconnect between what a financial buyer might be willing to pay for it and what they think they can get. And so there's just a lack of sort of transactions anytime, and that's That's all the way up from the big investment grade companies all the way down to the smaller companies.
Right, but if I'm remembering this correctly, we've seen this in the high yield market before, right? There have been times when there's been uncertainty in the market and there's just a gap, and everyone just sort of holds everything on the sidelines for some inflection point to come along. Is that fair to say?
Yeah, I think that happens to a large degree during pockets of volatility that may persist, and certainly it sort of becomes more attractive to buy things, but tougher to finance them at those times.
Right.
I think right now it's actually quite an advantageous time for companies to issue. There's a lot of demand out there, but there just seems to be not quite the level of supply, and I think that's okay and that's healthy for our market right now in the near term because interest rates are higher and there's certainly more than enough things on the horizon to be concerned about, where particularly if it's a hard landing or a no landing scenario, where we don't need to really push the risk spectrum too much further.
Right. And but you underscore something that's very difficult to get right now is sort of through the cycle information and perspectives, right? People are awful hung up on a lot of short-term things, not really thinking through the cycle too much. It's makes it kind of difficult. But the I hadn't really thought about the or connected up the growth of the NAV loans
Yeah.
with the high yield market. That's fascinating to think about.
Yeah,
Yeah,
it's been really interesting to notice. I think one of the sort of changes that has occurred is that when we do look at sponsor finance transactions and large issuers right now in the high yield bond market, and they're using to a larger extent the leverage loan market a little bit more. We're seeing larger equity checks, and the absolute percentage of those equity checks on some of the largest leverage buyouts have been much larger. And I'm quite certain that, there's other ways that they're sort of boosting the returns for their investors, and NAV financing is one available option to them.
yeah, for sure. Going forward, are there any other risks that you all are tracking to the sector that, the CFAs who are listening to this, who, are maybe looking at trying to take advantage of the higher yields for their clients, should be thinking about?
Yeah, I think that the certainly there's credit risks that are sort of ever present, and I think we've addressed a lot of those in terms of the higher interest rates are going to have an impact. Some of the disruption is going to have an impact. I always go back to the fact that the high yield bond market has a lot of really steady long term businesses that have been around for decades plus, and so it gets you away from some of those things. But I do think there are macro and rate risks that just exist on the horizon, and those are the things that we're sort of thinking about the most. Is obviously, if you look at the high yield bond market and you look at rate markets overall, really at the beginning of this year, they probably got ahead of themselves in terms of expectations of Fed cuts.
Yeah.
Certainly, starting the year, I think the expectations were for 6 to 9 cuts.
Hmm.
And very clearly, I think we're going to hit much lower numbers than that,
Sure.
and certainly more than a few people out there suggesting no cuts. So I think that rate piece is something that investors need to think about, and not just piling into longer duration assets that might appear to have a better spread or a better all in yield when rates may not come down for some time. And I think rate risk, and then the macroeconomic picture, I think there's certainly things in the globe that are of concern and investors need to have in mind. Certainly some of the issues in the Middle East, but also, you know, Chinese economy is on less than certain footing, and I think that a lot of investors are thinking. Certainly we at Barings are thinking about things a little bit more globally, as a lot of our investors are very much globally focused in their investment horizons.
Yeah, there are a lot of interesting things in and around Asia also. For instance, if Chinese growth slows, one thing that I, been thinking a little bit about is what happens to sectors like the high end of the travel market, which was transformed by basically upper middle class Chinese users. So it's it is something that we have to keep our eyes on for sure.
Yeah.
Yeah, it's also, I mean, I think it's going to be exceptionally interesting to see how people moderate this because one of the things that I was taught very at a very early on in my career was don't try and predict interest rates. And yet,
I
and yet,
certainly, yeah.
and there
I,
we
I
went.
s- I certainly, I always caveat when I'm speaking with investors to take my view on rates with a large grain of salt,
Yeah.
because you know, within, existing in the high yield bond market and being in the high yield bond market for all of my career, I'll tell you that, the number of times I've been right on rates is pretty low. Um, but I do think, there's more than enough opportunities to overcome that with credit and just picking credits. And that's what we focus on. We think most of investors are well suited to picking managers who focus on credit and leave the macro and rates sort of views to other avenues.
Yeah, for sure. Well, that's perhaps a good place to leave it because that is something that is part and parcel to the CFA curriculum is due diligence. In this case, credit analysis. So, but thank you very much, Mike, for being here and sharing your thoughts with the members.
Absolutely. Thanks for having me. Appreciate it.
And thank you to those of you who listened to this podcast and downloaded it. If you're interested in more work that we've done on parts of the high yield market, I would encourage members to log into our website and see the high yield event that we posted back in February. It had some interesting things, particularly if you're new to the high yield market. Some basic stuff like which Bloomberg terminal commands to use, which of the companies are doing a lot of work in this area right now, and might be really helpful to you if you're thinking about a career move into high yield. So with once again, members can log in there for free and have a look around. Until next time, I'm Rob Rowan, and this has been Compound Insights.